My name is Sriram from the Commodity Research Desk at Reliance Securities. Welcome to the weekly Commodity Outlook. So let's begin with the bullion side of things. International and domestic gold prices rebounded this week as the dollar rally stalled and as US Treasury yields eased from the recent highs, as caution prevailed in the global financial markets due to the uncertainty surrounding the US debt ceiling deal. The deal was, of course, agreed over the weekend on Saturday between Democrats and Republicans to raise the limit further, but concerns emerged that the deal may not pass the vote in the US Congress, as some Republicans were opposing it. So I think this lent some support due to the safe haven appeal. Prices recovered from the lows of the week of last week, in fact. Additionally, the markets also witnessed some fund managers squaring off positions at the end of the month of May, taking profits from the recent selling in the markets, and that too pushed prices higher. However, upside or a big rise in price was missing as due to the hawkish Fed expectations. Markets are still factoring in that the Fed will hike rates by another 25 basis points in the month of June when they meet, and that capped further upside in the markets. And we see markets remaining range bound in the coming week or so. Of course, the key trigger will be the vote in the US Congress, which is scheduled for Wednesday on the US debt ceiling. That will be the key trigger for the markets. There will be a big relief if the debt ceiling deal has been approved by the US Congress going forward. Some relief really can be expected, but Fed speak and data will be other triggers for the markets, especially the non-farm payroll numbers on Friday is a key trigger or key event for the markets, and markets can remain range bound ahead of that. Also, this month we have the FOMC meeting on 14th, 13th, 14th. The outcome is on 14th, and that will be also a key trigger for the markets. Of course, the inflation numbers from the US ahead of that meeting will also be a key trigger. So pretty busy calendar week for the bullion markets, and we expect the markets remaining in a broad trading band of $1940 on the lower side to 2010, 2020 on the international side. Domestically, August futures can remain in a broad trading band of 59,000 on the lower side to 60,400, 60,500 on the upside of things. However, these ranges will change depending on what the outcome of the US vote is, and of course the data points over the next few days session. So these ranges can change after that. On the crude side, crude prices struggled this week domestically and internationally. Earlier, prices had recovered on the back of rising gasoline demand. US demand for gasoline remained strong, with motorist group AAA predicting Memorial Day holiday weekend was the third busiest auto travel since the year 2000, and that lent some support to the markets. But also we saw support coming from the supply side. US oil rigs fell by another 5 units in the last week to a total of 570, and this was the biggest monthly drop. And in the month on a month-on-month basis, it was seen that the rigs fell, and it was the biggest drop since June 2020. However, after the initial upward momentum or upward move, prices gave up all its gains and struggled throughout the week amid concerns that the US debt ceiling deal may not be passed in the US Congress. And of course, recent weak numbers from China has definitely weighed on sentiments, adding to downward pressure over the last few sessions. Additionally, mixed sentiments or mixed reactions from OPEC and non-OPEC producers kept investors cautious, as most participants do not know what the OPEC is going to do in the weekend meeting on Sunday. So markets investors remain cautious, and possibly ahead of that OPEC meeting and ahead of this US debt vote, where US debt ceiling vote, markets can remain range bound to slightly on the negative bias. due to the uncertainty surrounding the event. So I think we see more correction, at least in the short run. We see more correction. On the charts, we see the NYMEX July contract can test $68. That's a key support for the markets. But a break below could pull prices all the way down to 63. On the upside, we see 75 needs to be broken clearly. Then only we can see some bullish momentum in the crude prices. Otherwise, prices could struggle this week. Finally, on the base metals and copper and other base metals continue to struggle this week, continue to face headwinds this week. Again, data released by LME over the weekend showed that the hedge funds are shorting LME copper for the first time since the outbreak of COVID-19. Additionally, bearish bets also increased in the COMEX futures, where the speculators have increased their net short positions there as well, and and so bulls close their positions on a month-on-month basis, and that intensified the selling in the markets. Of course, supply also increased. We saw that aluminum inventories rose for 5 straight weeks, which also intensified selling. But overall, the recent numbers from China also remained weak. The latest one is the China manufacturing activity, which came out today, was extremely weak, along with the non-manufacturing and the business activity. Everything slowed down in China, reflecting reflecting weak economic conditions in the country, and definitely dashed the recovery hopes from that nation, and this kept the markets upside extremely limited. And we expect in the coming week or so, copper prices will continue to weaken further. Of course, the key trigger, like the bullion and the crude energy markets, will be the US debt ceiling negotiation passage through the US Congress. But the main trigger for the copper prices will be the upcoming numbers going forward from China, and that will be a key trigger going forward, moving the market. So overall, we do see continued sell-off. Possibly on the copper side, we see 700 retesting again going forward this week. That's a very key support for the markets on the charts, and if that level is taken out, then further sell-off towards 650 is a possibility for the domestic copper futures. So more weakness is possible. On the upside, a clear break above 725 is required for the bullishness to return to the market. So fundamentally speaking, we still feel copper has some more sell-off to go, some more weakness to see ahead of key events going forward during the coming week or so. So that's it for from our side. Thank you very much for listening. Have a pleasant day and a week ahead. Thank you.